QuickBooks Online 2021 forward contract for speculation that foreign currency will strengthen adjusting entry. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our QuickBooks Online problem 2 multiple currencies forward contract practice file. In prior presentations, we set up a 30-day free trial and then turned on the multiple currencies, which once turned on can't be turned back off. Now we're going to be opening up our financial statements to continue from here. To do so, we'll go to the tab up top, right click on it to duplicate it, and then duplicate the duplicated tab by right clicking on the duplicated tab to duplicate it. Going then down to the reports on the left-hand side, we'll start off opening up the good old P&L, profit and loss, the income statement, date range change up top. I'm going to say for my purposes, it's going to be last year. So we're going to say last year. I'm going to run that report, hold and close up the hamburger, hold down control, scroll up just a bit to that 125%. Same thing for the tab to the left, except we're going to go to the reports this time, open up the balance sheet, the good old BS balance sheet report, do the range change up top, and we're going to say last year. I'm going to say last year for this one and run that. Close up the hamburger. Last time then we put on the books the forward exchange contract speculating that the Australian dollar would become stronger with relation to the US dollar, therefore discussing with the broker, exchange broker, saying, hey look, we would like to receive foreign currency units in the future, saying 100,000 foreign currency Australian dollars in the future, and we will pay you in the US equivalents given the current rate. So we put then on the books the receivable here that we're going to be getting in foreign currency units, Australian dollars in the future, valued at the current rate, not the spot rate, not the current exchange rate when we put it on the books here, when we negotiated this transaction, but rather on the forward exchange rate, because that's what the broker is going to allow us to put it on for, which is a little bit different than if we were to do other normal type of transactions such as purchases and sales for foreign currency units. And then down here, we've got the payable that we put on the books for the same amount, except for this amount we're going to pay in the future in US dollars in the current negotiated exchange rate that we put it on the books for, which was that speculative type of rate. So now if we go back on over to Excel, the next thing we want to do is say, okay, now it's the end of the year. We're going to pretend it's the end of the year now, and we haven't yet, it's not the due date, meaning we put this on the books at 12/1/X1. It's going to become due on 3/31/X2. So, but before that, we're going to have the financial statements as of the end of the year, and we want to do our revaluation as of the end of the year to make our financial statements correct as of that point in time. So we need to reflect then this receivable using the proper amount for our financial reporting at that point in time. Now this payable isn't a problem because it's in US dollars, and that's our measurement tool. So we need to adjust this receivable. So that's going to be our plan. Let's pull out the trusty calculator. To do this now, we're going to say, okay, we're still going to get the 100,000 Australian dollars in the future. So we're going to take that 100,000, multiplying it, you would think, times possibly the spot rate as of 12/31. But no, we're going to be multiplying it times the forward contract rate. So once again, we're going to use the speculative rate because this is a speculative item here. So we're going to have to use that other rate, which will not be the rate that QuickBooks will determine for us because it will determine the spot rate. So we're going to have to get and determine what the speculative forward contract rate will be in some other way. So we're going to take the 100,000 times the 0.612, and that'll give us the 61.2. If I subtract that minus the 6,900, we have a difference or a change of $300. Now, if we think about this, we're going to say, okay, you know, is that good or bad? Well, we could see this is 0.609. That means for one Australian dollar before, the forward rate would be speculated that they would get then 0.609 US dollars. And now we're speculating that one Australian dollar would get 0.612 more US dollars, or more of a fraction of a US dollar. Therefore, the foreign currency got stronger. And so for us, that's good because we have a receivable and we're going to get paid in foreign currency units. So at this point in time, it looks like our speculation is paying off. It was a good speculation. So we'll do this. We're going to say then this foreign currency receivable is going to be going up. We're going to have this gain here, which we're going to call foreign currency gain. And then I'm going to do this calculation again. I'm going to do it a slightly different way this time. I'm going to take the current rate minus the prior rate, multiply it times the 100,000. Same kind of result, just different algebra. So we're going to say this is going to be equal to the 0.1612 minus the 0.609 brackets times the 100,000. That's going to give us our $300. So there's going to be our 300 debit and credit. If I was to record this out in, say, a journal entry, I'm going to double click on this transaction, say plus, there's the debit, increasing the 61.2, and then the gain's going to go down here. We're going to put the gain in this year, in the year 1, even though the contract is still on the books. So there we have it. So now we're going to have to do that in QuickBooks. So let's go ahead and do that in QuickBooks. Now, because in QuickBooks we set this receivable up not as a accounts receivable. In other words, if I go back on over to QuickBooks, this receivable that we're going to get in foreign currencies in the future, we didn't set up as an accounts receivable. So we don't have to deal with the same kind of, possibly like an invoice or a customer kind of issue related to it. We got to do it just with a straight journal entry. So what we're going to do in QuickBooks will mirror pretty much exactly what we did in Excel. So let's go back to the first tab and simply just do a journal entry for it. I'm going to hit the old drop down. We're going to say let's do a good old journal entry as of the end of the year. I'm going to hold down Control, scroll down just a bit. And now I'm going to keep this one in US dollars because I'm just going to do a straight kind of journal entry, and the exchange rate would not be helping me within QuickBooks to do that. In other words, if I was trying to use QuickBooks to help me out with the spot rate, I might, for example, change it to the foreign currency and then use their calculation to determine what the rate should be. But I can't do that here because that, even if I looked up the rate that QuickBooks gave us, that would be the spot rate, and I have to use the forward contract rate. So I'm going to have to look on the market and talk to the broker to see what the forward contract rate, not the current spot rate. So we would have to do basically the same calculation we did in Excel. We'd have to learn, okay, what's going to be the forward contract rate? And if we determine that, all right, it's going to be, as we said, that 0.162, we can say, all right, well, we got the 100,000 times the 0.612. That's going to be the 62.9. Same kind of process. And then I'm going to go, okay, what's on my books right now? On my books, I'm sorry, that's a 62.2. Currently, I've got 60,009. So minus the 60,009, that means I have a $300 amount that I'm going to have to record to increase the receivable. So I'm going to say, all right, then I'll just do that transaction. This is going to be the receivable. We're going to say this is 300, and then I'm going to call this an ADJ entry. And I don't need a name over here because it's not going through an accounts receivable account. If it were, I would need the name. And then I'm going to call it exchange gain loss, receivable broker exchange gain loss. Now this is an account they haven't set up for us yet, because sometimes when I do an automatic transaction, QuickBooks will basically add this account. But I'm going to add it here. I'm going to say that it's going to be an expense. Let's make it an other expense. Therefore, it'll be basically at the bottom of the financial statements. We're going to then say that this is going to be an exchange gain loss, and therefore I'm going to have it, one account will flip between whether it is a gain or loss. In other words, gains and losses will net out in this account. So I'm going to save it and close it, and that looks good. Let's save that. See if it does what we would expect. Back on over to the QuickBooks. Let's run it. Hold down Control, scroll up just a bit. So now we're at the 61,200. If I go back then to Excel, does that match out what we have here? 61,200 looks good. And then the other side is going to go to the income statement, going to the tab to the right, scrolling down. Let's go ahead and run this one. And so there we now have this $300. We put it at the bottom, so it's not, in part of normal operations. This is our exchange gain and loss at the 300 down below. So that looks correct. Let's go ahead and then look at our trial balance going up top, and we'll go to the hamburger reports, open up the trusty trial balance. We can just check this stuff off as we go. Balancing trial balance. And then we'll hit the date range. We want to see last year, and run it. So there we have it. So now we got the 100,000 in the checking account, the 61.2 in the receivable, right? And that's what we have over here, 161.2, 60,900 in the payable. No change to the payable because we're simply going to pay that in US dollars. So now the receivable, based on the current exchange, is greater than the payable based on what we have at this point in time. That's why we're going to benefit, because we're going to be benefiting. We're going to get something in the future that had a greater value at the point in time that we're going to get paid it than we had when we put it on the books and agreed to pay the equivalent amount in US dollars. The difference has now a difference in our benefit in terms of the perceived value of the currencies at the point in time we're going to get paid, or at least this point in time. It'll change in the future. And then we've got the retained earnings, 100,000, and the 300 gain. So we've got the 100,000, the 300 gain. So everything looks good. We'll print out the trial balances as we go, so you can use those as a reference if you're following along.